It's my pleasure to introduce Cherie Santos-Wuest, who's the managing partner at Celadon Venture Advisors and also an invaluable member to our Yale Area Conference Committee. Please welcome Cherie to the stage.
Hey, Cherie. All right. I'm waiting for people to come back in from networking, which is hard for real estate people, but good afternoon, everyone, and thanks for joining us on this beautiful Friday afternoon in New Haven. Peak season for Connecticut, I hear. As Francis said, my name is Cherie Santos-Wuest. I'm a managing partner at Celadon Venture Advisors, as well as a board trustee for the NHB Foundation and its subsidiary and the nonprofit development firm which builds and preserves affordable housing, as well as its subsidiary Operation Pathways, which provides supportive services to those affordable housing communities. I'm so pleased and honored to moderate this panel of our brilliant practitioners here today and industry leaders. We have, from the outside, Dara Kovel, the CEO of Beacon Communities, Steve Green, our own Steve Green, CIO of the NHB Foundation, and Perica Bell, Managing Director of April Housing, a subsidiary of Blackstone. I'm going to start with Dara. If I could have all of you please provide us with a brief intro and introduction to your firm.
So good afternoon, everyone. Dara Kovel. I am CEO of Beacon Communities. I'll tell you about that in a second. One of the things I like to share, though, is that I'm also a New Haven resident, and I kind of grew up here, went away to California to start my career, and then came back to New Haven, raised my kids here before moving up to Boston. So Beacon Communities is a Boston-based real estate, affordable housing, mixed income housing development owner and manager. It's the successor company to Beacon Companies, which was a very well respected transformational developer in the Boston area, primarily in Massachusetts, 50 years old. Beacon Communities was kind of reconstituted about 25 years ago as an affordable housing developer. Over that time, we've created 18,000, now close to 20,000 units actually of affordable housing. We're based in the Northeast and Mid-Atlantic. Again, we're an owner and a manager of those properties, and we do all sorts of real estate, primarily through the low-income housing tax credit. We have a big portfolio that comes from sort of the HUD heydays of financing, and we are operational in 12 states and in, again, the Northeast and Mid-Atlantic. So.
Hi, I'm Steve Green from the NHB Foundation, Executive Vice President, Chief Investment Officer, and Chief Bottle Washer. So I like Dara. I lived in New Haven for 25 years post being at the university, and loved the city, and was really inspired by the earlier presentation about what happened at Commons, because Lord knows I remember some dreary meals in that place. So hopefully the food's better. It sounds like it is. We're a nonprofit affordable housing developer on a national basis. We have about 10,000 apartments in 17 states, from Texas through the Southeast to Florida up to Massachusetts. We own, build, develop them. We're active in the Mid-Atlantic area. We have a couple of properties in Connecticut, but that's what we do. We operate on a national basis, and I'm pleased to be here.
Good afternoon, everyone. My name is Perica Bell. I serve as head of preservation, managing director of April Housing. April Housing was created when Blackstone acquired a large legacy portfolio of affordable housing units, all low-income housing tax credits, roughly 90,000 units across 44 states. When they completed the acquisition, they made a public commitment to maintain the units as affordable. And that commitment is made possible by Blackstone Real Estate Income Trust, provides a perpetual capital vehicle and patient capital, which is perfect for affordable housing because, as you'll probably hear later, it requires a lot of patience. What I do at the company is really to execute on that strategy in various ways, including one of the biggest ways to preserve low-income housing tax credit affordable housing is through a process called resyndication, which is essentially taking those tax credit units and putting them back into the tax credit program. That won't be the only solution. It can't be the only solution due to constraints that we'll probably talk about a little bit during the session. And so it's also about finding other solutions, collaborating with state agencies and local agencies to provide other solutions to preserve affordable housing.
And so I don't know how much familiarity the audience has with affordable housing versus market rate housing. Some of you may know affordable housing with a capital A being that which is subsidized by the government, affordable with a small a being naturally occurring affordable housing. But I'd like, for one of our panelists to discuss this a little bit. What's the difference between affordable housing? How does affordable housing get financed versus, say, market rate? Any of you?
So I'll start because I think one of the most important things for people to understand about affordable housing different from market rate is that affordable housing is a source-driven business where market rate housing is a use-driven business. So in our business, we're all about how much can you raise from usually cities and states and the federal government in order to develop a capital stack that finances the property that you want to build. And as a result, our primary client, we have residents, 18,000 residents, but our primary client is actually usually state governments because all of the policies that drive how resources are allocated, the primary resources, which is the low-income housing tax credit, come from the state. And once we can secure, create a program and a development concept that is aligned with state policy, then we gather another 6, 7, 8, 9 uses or sources of funds, put them together, and create the housing. So that's one of the things. And there's no hard equity involved. We're doing our work largely with other people's money in affordable housing. Conceptually, we're paid a developer fee, and we get some cash flow if we do it right. But that's sort of, those are the economics of the business.
That's really interesting because even though it's source driven, it's also driven pretty hard by demand. If I'm not mistaken.
I always say to people, there's no shortage of demand for us. It's a totally different, it's almost upside down from market rate real estate, particularly not only the supply-demand scenario and paradigm, but also Dara says the way it's financed. It's the equity is only invested for purposes of the dollar for dollar reduction in federal income taxes that institutional investors get. But the difference also is you have between affordable and small a and capital A is really, are the units regulated? Are they regulated either by covenant? Are they regulated by covenants from the low-income housing tax credit program? Or some other. But I'd say probably 95% of the units developed in the country today, I don't know whether you guys would agree, are developed through the Low-Income Housing Tax Credit Program, which is Section 42 in the Internal Revenue Code, which drives investment in return for tax credits. And it's in a capital stack, it's usually the largest or second largest part of the capital stack that is, as Dara mentioned, is often somewhere, we're closing a project in New Haven. It's got 8 sources of financing, 56 units, 8 sources of financing.
So I'm so sorry we don't have that slide to show you, although it's very difficult to follow the last panel with respect to slides and pretty pictures. But if anybody wants to see what a low-income house taxing financed capital stack looks like, Steve has it on his phone. He'd be happy to share it with you afterwards. Perica, any words of especially when you're talking about cash flowing property. I would think that is there a reason why BREIT was married with your business that way?
Well, Stephen talked about the demand. There's always a demand for affordable housing. There's some really attractive fundamentals when it comes to affordable housing. Yes, it is very, very hard. The capital stack can be very voluminous. But one of the things is that, the national default rate on affordable housing is less than 1%.
So that's, I'm going to throw in an anecdote there. When I was doing socially responsible investments for TIACREF many years ago, I had a tax credit portfolio that we had to sell. And one of the stats that I ran across from a 2007 E&Y study was that the default rate on low-income housing tax credit financed multifamily was 1/10 of that of market rate, which is pretty significant.
That stability of the business has certainly attracted a lot of institutional and private capital into the space that in some ways is beneficial to us because it creates competition, but sometimes it's also attracted private developers with that private capital. And I'd say I think that the level of competition in the industry, and competition's good, but it's a substantial amount from private market players that weren't in the space 10 years ago.
Well, that's an interesting turn, and so we'll see how well that works. And we're going to go from shallow waters into deeper waters here. That was a freebie for you. We're going to get into the meat of the discussion. One of the stats that resonated with me at our symposium last year, and this was from Jeff Olivetti, who was President Biden's SAR for homelessness, was that in the mid-1970s, the U.S. had a surplus of about 375,000 affordable housing units. Today, as of 2020, we had a deficit of approximately 3.4 million affordable housing units. How do we go about reversing this course, and how does this factor into your business plans?
Well, interestingly, the history of affordable housing finance, coming out of the Housing Act of 1948 is the HUD was very active in the 50s, 60s, and 70s in creating housing. And a lot of the portfolio that we think of as affordable housing when you're driving through your communities came out of that movement and that funding resource. The last of those programs dried up in 1982, and it wasn't until 1987 that the concept of this low-income housing tax credit came about. It survived because both Republicans and Democrats like it. Republicans like it because it's a private investment for private firms. Democrats like it because it creates affordable housing, but it hasn't had, it is really the only generator of affordable housing right now. The real solution would have been Build Back Better. That the scale of the program that was contemplated at the federal government in that program would have transformed the production of affordable housing. There has never been sort of even talk of anything like that before or since to really transform the amount of resource that would be necessary to generate the kind of affordable housing that we need. And absent that, it's going to be a real challenge to ever meet needs, particularly in coastal communities up and down the eastern.
And you do need, with 95%, as Steve said, of public financing in affordable housing. I think we tip the scales a little bit more towards private financing, don't you?
Yeah.
How about you, Perica?
Well, in order to kind of address that issue, you have to address kind of all the phases of housing production and housing preservation. So, since 1987, the low-income housing tax credit program has produced a voluminous number of affordable units. Those affordable units have different time frames of which they can expire. So, they typically have a 30-year time horizon of when they can be affordable. However, at year 15, once the investor has taken all of their benefits plus a 5-year compliance period, an owner can petition from the state to essentially convert those units to market. And then, of course, you have the end of the 30-year period when they go to market. And so,
do they automatically go to market?
At year 30, that low-income restriction expires unless you do something about it to place those back into the tax credit program, or you self-restrict. And that is a decision that you would have to make. And so Our stance is that if you don't address the existing units and preserving those existing units, you can build. You can build, but you still have a net loss given the amount of units that are already exiting the
And there's obsolescence as well, right?
And
Steve, you
have
want to
to
talk a little
Well,
bit
the
about
the cost
what we
of
do to
producing a new
preserve them?
unit is so much more than the cost of preserving a unit.
Right.
So in the world of public sector policy, there's both preservation and new production. I spent 7 years in the district government, and one of my jobs was housing policy, and it got to be a real struggle as to how much do you put into new production, how much do you put into preservation. But the economics are just hard to argue with. The cost of preserving a unit is this, and the cost of creating a new unit is that. It's substantial. Now, we still need new units, but
Right.
so.
Yeah, this is a real. I was on a preservation panel at the National Council of State Housing Authorities up in Boston last week, and this is a true crisis in and of itself on the preservation side between the expiration of these tax credit restrictions and functional obsolescence. As these, particularly, half of our portfolio is sort of from that Section 8 era. At some point, investing $100,000, $200,000 a unit into buildings from that era can only, really isn't worthwhile. So there is a real crisis, and to have the policymakers really focus both on preserving the existing stock and producing new units is fundamental.
Which I'm sure has been amplified by the pandemic and exacerbated by rising interest rates. I don't know, between the two, can you all tell us about what the impact of either has been and which one has had the greater impact on your work?
Wow, rising. One of the things about rising interest rates, it means you can borrow less money. It means your capitalized interest during the development period is substantially greater. It's now, triple what it might have been three years ago. But it also means in the tax credit, the equity investment, because I forget what the exact number is, but when interest rates go up, the value of the tax credit goes down. It's just the reality of it is the investor can get money, can make other investments. These are institutional investors, banks, insurance companies, et cetera, and this is a portfolio of investments, and they can earn more money doing other things. So in low interest rate, we were getting 95 to 100 cents on the dollar for a tax credit. Today, you're getting 85 to 90 cents on the dollar, probably on a comparative basis or less.
And dropping.
And dropping. Dropping. So it's the interest rate environment has had a dramatic impact on the ability to produce, and what it means is you need more subsidy because every property we do. I think in the 10 years I've been in NHP, we've done 2 strictly debt and equity deals, no public subsidy involved in it. So you're always needing basically state resources, as you say, because most cities don't have a lot of resources to put into it. So you're talking about state resources. So if the rates are going up and equity pricing is going down, you just need more subsidy. And there's a limited pool of subsidy out there. So and generally, public bodies and between governors who propose budgets and legislatures that approve budgets are slow in reacting to that changing dynamic in the marketplace.
Yeah. I would say that while interest rates have caused a huge stress on the new production business, the other place it's of course given us a lot of stress is on the refinancing business. So we have, we refinance our properties like others. You can use that capital to reinvest in the buildings. That business has dried up. So for the last year and a half, we haven't been doing that, and we won't do that for the foreseeable future. So even that just kind of means the capital investment in the buildings is lingering or languishing. But the other issue, the construction costs are a much bigger component of the overall issue I think that we're struggling with, partly because our debt tends to be much smaller on our affordable housing, because when you're buying down the debt with your public resources so you can charge less rent. So as a percentage of your overall capital stack is a lot lower than a market rate deal. So interest rates being at this, at 8% stinks, but it doesn't hurt quite as much as in other asset classes. On the construction cost side, it's just been a disaster because, by the time, I think to Stephen's point, like by the time you go out to bid, you have a gap, whether it's $1 million or $5 million or $8 million in your deal. Again, these are deals that are 60, 70, 80 units for a variety of reasons we could talk about. And then you go to the city or the state and you ask for more money. By the time they make that decision, your numbers have gone up again. And I just heard numbers. We have the last phase of a 1,000-unit redevelopment up in South Boston. It's 90 units. We had numbers from a year ago that we just went out to bid. It's a full 100% union, wood frame, no parking, sort of straightforward deal. And the pricing has gone up 14% year over year from last year. And like at this point, we've heard that there's softening in the market, that the subs are hungry, that because market rate development has stopped, that all should be showing up. And yet it's not showing up yet in the numbers.
Is there a lag to that?
It is definitely a lag. And I think there's still enough backlog that people are not, hungry enough in the construction field. So we're really struggling with that.
And I've been with April Housing for a little bit over a year. Before that, I was a tax credit investor and a lender at a bank. So, what I could say from both sides is that there are just, very large closing delays because of all of the stakeholders involved, whether they are subordinate lenders in your transaction, or you're trying to build or pull a building permit. It took all the while longer to get to the closing table, exacerbating rising interest rate issues because your deal pencils, and then a month later, as you're trying to get to close, maybe that no longer pencils. It underscores all the stakeholders involved in the transactions. But again, kind of across the kind of whole line, there's also staffing challenges. So staffing challenges at the local agencies, again, like that's about the same probably for any commercial real estate development when you're trying to get a permit or trying to get your building card signed off to complete a deal. Affordable housing tends to have other challenges such as, having to comply with ADA guidelines. That's another staff person. And so all of that kind of flows through from closing all the way to trying to complete your deal, which is very important in the tax credit world to complete and get qualified occupancy so that your tax credits can flow.
And so I hear about this at board meetings as well, but you should also hear as well from Steve personally about how those, it's all connected. The delay of coming back to office means that the public financing folks are not usually there when you pick up the phone. Can you tell us a little bit about the delays in public financing? Has that eased off a little bit since the pandemic?
Well, actually, I found one of the things about pandemic was it actually made public sector officials more easily accessible because it's so hard to get in to see some. But I found that, people were much happy to get on a video call. And so in some ways,
good to hear.
It's, accessibility, although I completely agree with it, as time goes on, there's changes in the public sector and you get a new person and you got to get them up to speed and they may have a different view and a different opinion. And it can be a nightmare in terms of the changing, the people that sit in the seats. But accessibility is, I think, improved as a result of the advent of video technology into the normal workplace. So.
That's great to hear.
Yeah, I think it's sort of fascinating, the democratization, particularly of the public process and public hearings, land use. So for better or worse, people can log in at home, be a part of a public hearing, learn a lot about it. So you get a lot more access.
So decision making has become more fluid because of technology.
Yeah.
That's great to hear.
That said, the interest rate environment and construction pricing, which is probably 50 to 60% higher than it was 3 years ago, I mean, it causes, as I said earlier, it just means you need more subsidy. And there isn't that much more tax revenue available out there. There is an increasing sense in a lot of states that I think you all work in, we work in. We don't work on the West Coast; it's too far to go. So, but there's a sentiment towards it, but actually producing the hundreds of millions of dollars a year that a state needs to do to fund affordable housing has lagged behind. So we have an increase in cost increasing cost per unit. Our average cost per unit, probably depending on the jurisdictions, probably $500,000-$600,000 a unit, and that competes or compares with what was probably $300,000 to $400,000 a unit. A market rate deal is probably in the 4 to 5 at this point, depending on where you're doing it, what your land costs are. But there isn't the resources out there to produce more. It's a more democratized process, but I'm not sure the production is keeping up. Not only keeping up, it's not keeping up at par with where we were before. And I just point that out as an issue.
Yeah. So, in addition to the pandemic and rising interest rates, what other exogenous shocks have you experienced lately that has impacted your work? I'm waiting for somebody to say the word starting with an I here. Insurance.
You can do insurance. I hate talking about insurance.
Well, I started in this business. Insurance was a piece of your operating cost, which might have been like $5,000 a unit years ago, was an average cost, no longer. But in this, and it was like $100, $150 a unit. Sort of not really something you pay much attention to. You got to have it, but the cost didn't really matter that much. Today, that number is tenfold. Our average cost of insurance is about $1,200 a unit. And if you're in Florida or southern Louisiana, or the Gulf Coast in Texas, where we own about 4,000 apartments, that number is going to be almost double or triple that number. And so, on an average cost per unit of, managing an apartment is, say, $8,000 a unit, $9,000 a unit. Now our cost of insurance is $2,000 a unit. So that's 25% cost. And it's dramatic, the impact on operating, because that drives down. If your operating costs go up, your NOI goes down, and to the real estate folks, that means you're going to borrow less, et cetera. So you've got less resources.
So while demand continues, I can't help but wonder whether or not this impacts where you decide you're going to preserve and develop affordable housing.
It certainly is impacting our decision. We're in the midst right now of examining what we do with our assets in those locations, and where do we look to develop, since we have projects in the works in those areas, and what's the future? Because I'm not sure how economically or financially sustainable properties in southern Florida, Gulf Coast, and Louisiana. We have a couple hundred units, 300, 400, 500 units in Louisiana. It's really a question of whether we can sustain it. Right? I don't know what the macro world says in the real estate business about property and real estate and insurance.
I'm hearing similar stories across private equity owners and developers.
Yeah,
What about you, Perica?
Well, just to underscore what Stephen's saying, it's we've hearing the insurance story all across commercial real estate. What's unique about affordable housing is that you asked about kind of an exogenous shock. One of those rent limits and income limits are essentially set by HUD, and it's usually based off of a survey and data from a survey. Well, that survey and that data collection process was disrupted because of the pandemic. And what essentially happened was what was expected to have a higher of a cap based on previous iterations of that of that data and how it's interpreted came with a more moderated one. And so the ability to kind of have that stability of interpretation. When you get something like that, that's a shock where it's like, oh, I'm not able to, kind of increase rents the way I thought I would. And then you have things like insurance and other pressures. That makes it even the more difficult and affordable housing for everyone in the space.
Yeah. The other stress, back to sort of just the operating portfolios, is, if there are any other multifamily owners in the audience here, the consequences of the pandemic are going to take another 2 to 3 years, I think, to really shake out. We have, throughout our 18,000 units an accounts receivable balance that I can't really say out loud because every time I say it, it just depresses me to no end. It's finally started to flatten out, but we almost hit 8 digits in terms of the receivables that were due, and that was a combination of the eviction moratoria, rent freeze, people not being able to or not being willing to pay rent. And then just the kind of trying to come back out of that. So there's just been, and when the rent assistance, we probably received $4 million over the course of a couple of years of rent assistance from the programs that came out of the Pandemic Relief Fund and all the programs that were intended to support that work. But then those dried up too. So there's just a lot of stress within, I think, multifamily generally in that regard, in terms of both getting people back to paying rent and dealing with some of the
Have you had to go through any evictions on your properties because of that?
Yeah, well, and we really held off during 2021 and 22, and then we just this year, particularly in places, there are certain states that you could just business as usual, nobody was worried about it. I would say the Mid-Atlantic and other places were less concerned about that, except maybe DC. But then in places like Massachusetts, we were not doing any evictions whatsoever until about 9 months ago, and then we began to do that. And we have, again, a backlog of some people who haven't paid since the pandemic started, in spite of ability to do so. We have fun anecdotes about how people weren't paying rent, but then went and bought a house because they saved enough money not paying rent to go buy a house, which is lovely because people should. That's great. They have a home.
It's not always the thing.
Yeah, but those are the kinds of challenges that are in.
I can think of one particular NHP property that we've had issues with regarding this. You want to talk about it, Steve, or do you want me to describe
which one?
the one in Anacostia, I think.
Oh yeah, we particularly in DC, which is a very tenant-friendly environment.
Very
friendly. And the courts are very tenant-friendly as well. And so we don't generally evict for non-payment. We have, as Cherie mentioned, we have a resident services subsidiary that works extensively with folks, and we generally work out a reasonable accommodation. Either someone leaves or we got on a payment plan, but is the rare situation where we evict for non-payment. We evict for bad actors with regularity, but not for non-payment. But now we've been sort of forced, particularly in DC, we have 40% of the residents it's about half residents aren't paying the rent, and they're just waiting for the next government assistance program. And
it's very odd how rumors start. One tenant will say, "Well, you don't have to pay this," and everybody else holds off. And fortunately, it was only on one property, but I thought it was.
It is, and it's particular to DC. So we have the majority of our collectibles, which are sizable and got sizable, are in that community. Interestingly enough.
Anyway, it's just touching reality here.
Yeah, right.
Tell us a little bit about the drivers of demand. I mean, everybody knows, everybody says, we need affordable housing everywhere because we're thinking about our kids or our cousins, our nieces and nephews who are going out in the world, and parents who want to get rid of their kids and want them to start new. But what are the drivers of affordable housing demand right now?
I mean, it depends on, who you're talking about. So when I think about, is it the end user who is the resident? You're looking at service amenities, you're looking at location, just like any other resident of a multifamily property. Or are you looking at it from the perspective of an investor or lender? That's typically underpinning your traditional commercial real estate underwriting. For lenders and investors, especially ones from banks, you're looking at community reinvestment credit, and you're also looking at, to the extent investing and lending meets with their, kind of policy goals like ESG. And then you have your state agencies, which play a really, really big part. I know that Dara touched on this earlier. But each state agency has a set of their own policy initiatives and goals that they want to accomplish and achieve.
But ultimately, who are the beneficiaries of this affordable housing? Because one one would like to think that there are people behind all these and not just investors.
Yeah, no, I mean, and it
Agencies.
depends. In different states have different priorities, but they're oftentimes targets for people at 30% of area median income, or 50 or 60%. Workforce housing is always a popular kind of phrase, and that traditionally means something above 60% of area median, and the market, up to 120.
But under 120 AMI.
Yeah.
Right.
So, I think what we find in affordable housing, we don't really think about demand, sort of back to Stephen's point about
Well, you don't have to.
we don't have to. We've
Right.
got wait lists that are even in softer, more tertiary markets. We don't worry about filling these units. But it depends on who you're targeting and what the
We're looking, to your point about tertiary markets, we're looking at a project in Rotterdam, New York, which is, I didn't know Rotterdam existed until a few months ago. It's south of Schenectady. It's a very nice community, but it's a tertiary market, and the demand for affordable housing there is there's a high demand there as there is in New York. I mean, I don't know the percentages, but there's a high demand. They need affordable housing. They have the same issue. People can't live in Rotterdam who once, worked there, who grew up there. But I would like to point out that most of our units, and the tax credit, the low-income housing tax credit program has an income limitation of 60% on average AMI. You can, if you elect, and most investors don't like it, but you can go up to 80 as long as you've got a corresponding one at 40. So the average is at 60%.
Oh, I see.
You have to make that selection. But at 60% AMI in most communities, those are working families. Those are families that got jobs, one or two wage earners, not very high wage earners, but they're wage earners. They're working, they're going to a job every day. They have to have a car or be near transportation. But it is even at 60% AMI, it's a workforce housing program.
Yep.
The low-income housing tax credit program is not, it is not a free ride. It is not, the rent is not zero.
Right.
And we need rent to operate the property. As Dara says, there's de minimis amount of cash flow. These projects are highly leveraged. I mean, we will leverage a deal to its maximum, the maximum that the investor and the lenders will allow you to. So it's all goes into operating the property. But
I guess I should probably point out that when we were kicking the tires in some of the NHP properties one time, it shocked the heck out of me that I saw younger people, single as well as two working parents, living in these homes. They were not at all the welfare mothers that you hear about. So I have a couple more minutes, and I didn't want to leave this all on a downspin here. Tell us what works, and where does help come from? If you had, two wishes, and how do we scale this, the creation of affordable housing? Because we all agree we need more.
Well, there are a couple of powerful tools that make it happen. Obviously, leadership at local and state levels is critical. In my now home state of Massachusetts, there were two recent passages of measures. One that was signed by the governor a couple of weeks ago that increased a state housing tax credit. So it's a companion piece to the federal tax credit that allows for production on a scale that is, I think, not happening in any other place, but for maybe California, maybe a little bit in New York State. But a very powerful resource that can happen there. New York State is talking about a tax policy that would give affordable housing property tax breaks, and when you can have certainty and a reduction in your property taxes in these projects, you can leverage more debt, and it can also be a very powerful tool. So those are a couple of the critical types of tools. The other thing that is really the most powerful tool for affordability is the Section 8 program, because the Section 8 program creates affordability at a level that doesn't really exist. It also guarantees the landlord, owner, developer a fair market rent for that unit, that if you can project base it, you can actually leverage it and create
for the
affordability.
investor, great rent stability.
Yeah.
Steve, real quick, we're doing a power
Well, I think just the issue of scaling it was, as Dara mentioned earlier, the Build Back Better was an effort to really scale it. If some of the modifying some of the rules in the tax credit program would be a big help in terms of the 50% test, which is a longer story than you probably want to hear. But that would double the amount of tax-exempt bond authority that's out there, and 4% tax credits. But I will say that I think public will, translating into political will make a big difference, because we can't do this where there isn't political will. And this project that I'm very proud of, that we're closing on the last site on the Route 34 connector, up at the intersection of the Boulevard and Legion Avenue. If it wasn't for the will of the folks at CHFA, Dara's old agency, and the State Department of Housing, this project wouldn't have got done. So I give those folks a lot of credit, because they helped us figure out how to fund the increased cost resulting from interest rates and construction. So that, I think, will also go a long way as political will develops towards creating economic opportunity.
Thank you. Perica?
I'll say two things, and I'll try to be quick. One, I've been in the affordable housing industry for almost 20 years. And when I started in the industry...
Started at 5, right?
Quite. But when I started in the industry, I never really kind of thought that affordable housing would get to a state where you'd have institutional investment. And it's really exciting to now be in that space where you might be able to, we're so used to, like, how do we make these deals work? How do we make them pencil? To be able to still focus on that.
With string and paper.
Right. But also look, a couple steps beyond and say, okay, let's ask these questions a little bit differently. So that's really exciting to me. On a micro level, there were some things in the Inflation Reduction Act, namely the Section 48E credit, which pairs affordability and energy efficiency. You're able to bring in potentially a little bit more equity into deals, whereas before you kind of had to pick one or the other. So that's what I'd say.
And I don't know if we have time for questions whatsoever. But
We have time for one quick question, one quick answer.
We plan that.
Who's got a quick answer?
the gentleman up here.
I just came back from a trip in Singapore, and I thought it was so interesting that, city-states like Singapore or countries like Austria, it seems like the public housing sector is able to produce housing that's not only competitive versus the US, but competitive versus the private developers. So I guess the question is, if you could be in charge of HUD or regulations, is there any regulations that you would streamline or change? And why do you think this disconnect happens in the US?
Zoning
And land approval process.
Yeah, no, the local control of zoning laws is the thing that stops affordable housing from happening, period.
Think NIMBY,
Yeah.
among other things. So I know there are a lot more questions.
That was a quick answer, right?
Yeah,
was
one,
very
And it was in unison.
And
We all
We
agree.
ditto.
except for
and you all agree on it. Please join me in thanking our amazing panelists for sharing their experiences.